Okay, we're going to pause for just a second as we have attendees coming in, and then we will get ready to go here in about 8 minutes.
Guys, how you doing?
Well, hello, everybody, and happy Tuesday. We have 4 minutes to showtime. Mike, Adil, looking forward to doing this program with you guys, diving into R&D credits. Lots of changes, lots of stuff to talk about, so this should be interesting. For attendees who are joining, while we give it a couple more minutes for everybody to dial in, Would love for you to drop in the chat or the Q&A panel. There's both in this platform, so we will be monitoring that through this webinar. Give us a shout. Let us know where you're dialing in from. And how's the weather? Into springtime. We've made it through tax season and moving into summer. It's going so fast. I'm based in Las Vegas. Adil, where you at?
I am in good old Houston, Texas.
Nice. Is it getting hot yet?
It was hot yesterday, and then today it's a thunderstorm outside, so you can never guess.
Sounds like springtime. Mike, how was it there?
Oh, all good in Charlotte, North Carolina. Weather's beautiful today. We had a cold front come through, and it's amazing in spring when you're like, you love the cold fronts to come through because you don't want summer to happen too fast.
Yep.
Now, if we could just get some rain, with never-ending climates these days, it's either too much or too little, but we need some rain now.
I know, springtime's the time, isn't it?
April showers. What happened to
that? Yeah, it's pretty weird living in Las Vegas because it's like rain. What's that? Never. Yep, it's getting warm here. So if attendees can hear us, let us know where you're dialing in from. There is a chat function as well as a Q&A. So feel free to comment on either of those panels. We would love to hear from everybody. I always love to do a sound check. So confirm, can you all hear us? Is audio good? Can you see us? And confirm that we are live. So everybody is on board and ready to go. Okay, we have about 1 minute to go. Okay, well, Mike and Adil are going. Let's see. I don't see attendees, so maybe we don't have a chat function open for attendees. It's kind of strange because nobody else is commenting. So please make sure if you have any questions to jump in Q&A and let us know as we are prepared. A couple of housekeeping items, again, as we continue to have people log in and join us for this program today. We do actually offer continuing education. So if we have any CPAs here who are looking for CPE credits, we will be offering CPE. I have a few poll questions which are required to show attendance for the event. So make sure to watch for the poll questions and answer those as we go. Additionally, at the end, there's a confirmation as to whether you want CPE or not, if you need a certificate. So please make sure, wait for that poll question to respond to that when we get to it, so that we can make sure and send that out to you. So
Heidi, it looks like the chat's disabled for the attendees, but they can chat in the question box.
Perfect, got it. Okay, I can see that. So Mindy, thank you so much for responding. And it looks like Brian is coming in from Chesapeake, Virginia, and it's a sunny, beautiful day. So amazing. All right, well, with that, it is 10 a.m. Pacific time, 1 o'clock East Coast time. We usually have people here from all over the country. We are very excited today to bring some amazing people here and talk about the R&D tax credits. So this is maximizing innovation incentives and really understanding how this works for clients, some of the changes that happened in the One Big Beautiful Bill, and not only talking about a lot of technical things. We are going to have some technical guidance on how a client can claim an R&D credit, what qualifies and what does not. But additionally, some case studies, because sometimes it's like, what does this mean? What are we talking about? What's the potential benefit? So, let's really bring it down to applicability and how that rolls. First things first, I'm going to run this quick poll question. I would love to know what your area of interest is. Are you looking at R&D activity for yourself? Are you a tax preparer, an educator, consultant, or something other? So please make sure and respond to the poll questions there. This really helps us really be thinking about you as attendees and how we can cater our conversation and make sure that we're drilling this into any of your specific areas of interest as we're moving through the program. So I'm going to give you guys a couple more seconds here before we move on, and then we will dive headfirst into this presentation. So we've got a few more people. I'll leave this up. As we move through this program.
And just a reminder for those that just joined us, if you do want to chat, hit the question mark that's at the bottom of your screen. You can chat or add your questions or comments in that. We can see it all together.
Absolutely. Yep. Any questions as we go, we will jump in and answer those live. And we love to have the dialogue. It's always fun. It's always interesting. And we want to make this specific to you. So we will publish results. We have lots of tax preparers, which is wonderful. A few people looking at R&D activities. So thank you guys for responding. With that, so I am Heidi Henderson, Engineered Tax Services. Each of us are here with ETS. I currently hold the seat of CMO, but I'm also a tax strategist and have been in this space for about 15 years. Mike, why don't you introduce yourself?
Mike Donofrio, Managing Director with Engineered Tax Services. I also serve as a Chief Products Officer, which encompasses strategy, new products, new ideas, other innovative things that we can do with clients, in addition to our core services. So if you have ideas or strategies, that's some of the things that I work on with our strategic partners. I'm based in Charlotte, North Carolina, and have been with the ETS team going on 18, 19 years. So it's been an incredible journey with the team as we grow.
Awesome. It's amazing. Yep. Mike and I have been working together for a long time. It's been amazing. Adil.
Hi there. My name is Adil Sarani. I'm the Director of Operations for the R&D department. So I work closely hand in hand with Heidi, Mike, and the sales teams and leadership to make sure the R&D tax credits are maximized, and we're keeping up with IRS guidance and making sure clients are being taken care of.
Absolutely. Thank you, Adil, so much for being here, and excited to have your expertise and really drill into this in what we see in this world. R&D is so specialized and so technical with how it applies to different industries. I'm going to breeze through a few slides, a little bit about ETS, just to give you guys a little background, share with you maybe some things you don't know. If you have been working with us, maybe this would be new to you. If you don't know us, then it's probably all new. So we'll give you kind of the baseline of who we are as a company. But we have used this phrase for many years. We marry the science of engineering with the principles of tax and accounting. We are not a tax preparation firm. I always like to preface that. And the reason being, we have amazing CPA partners. We're able to work very collaboratively with those teams to really help support client service and look at incentives and being able to create value when looking at where the incentives, where is the ability to save tax dollars and help business owners reinvest in their business and continue to grow and expand their successes. So we're really looking to level the playing field for every taxpayer. And we serve clients on the real estate side through business components, through R&D, and many other incentive spaces all over the United States. And we have just celebrated 25 years of business, which we're very excited about. These are our physical locations, but I will tell you, we currently have a staff of over 150 people, and pretty much everybody's remote. So we have feet on the ground all over the country. We have inspectors all over the United States as well. So looking at the map of where we are doing projects, it was really not an area we are not touching. So we're thrilled to see where we've grown, where we're touching, and how we're delivering services. Our core values is that we really want to put people first. We want to think strategically, deliver excellence, collaborate robustly, educate and evolve this program, so CPE for you guys, and maximize value so that it's very ROI focused. We are not I often say, we're not a sales organization from the sense of trying to just close a deal. We are looking at long-term relationships and building value, and it is what really matters to us, our company, and everyone on our team. So we have over 25 years in this business, over 75,000 studies completed in all 50 states. $1 million in tax services performed, and over $2 billion in client tax savings generated. And it just keeps growing. So it's amazing to see the tax benefits that are generated through many of these incentives programs. The things we specifically do are cost segregation studies, R&D tax credits, energy certifications for 179D and 45L. We do engineered incentive reports, which this correlates closely. We'll talk about this a little bit. Mike's going to cover incentive reports and how this links up to our R&D credit projects in identifying any applicable incentive for a business owner. We also have an amazing insurance brokerage for P&C insurance and liability policies, and 1031 exchange services. So of course, today we're talking specifically about the R&D tax credit. And we work with CPAs, accounting firms, commercial and residential real estate owners, architects, manufacturers. There's really not an industry sector we have not worked closely with. And some of the people on our team have such interesting blends of expertise that sort of all merge together. For example, we have an R&D project manager with a background in architecture. And so he is amazing at being able to support our architecture and engineering clients. We have a project manager highly specialized in software and understanding the technical lingo of building software. That level of expertise is really what allows us to help serve clients in every industry. And then this is a sampling of the family of companies that we have. Many people don't realize that we have a number of different companies all under our umbrella of engineered advisory and inside public accounting, and firms really focused on helping CPA firms grow, succeed, and be successful. And so with that, we're going to dive into the R&D credit in and of itself. So in terms of a summary, I'm going to pass it over to Adil and have him go through some of the technical aspects of R&D. After we go through some of the technical pieces, we'll shift a little bit and we're going to have Mike go through some case studies and a few other topics. So Adil, take it from here.
Heidi. All right. So first, I want to level set with what exactly the R&D tax credit is. The R&D tax credit is a federal tax incentive under Internal Revenue Code Section 41, designed to reward businesses that invest in innovation, meaning they're developing new or improved products, processes, formulas, inventions, software, or technique. Now, the big takeaway here is that it's a dollar for dollar credit, not a deduction, so it can directly reduce your tax liability, and it also applies to ongoing improvements, not just huge breakthroughs. So you don't need to be inventing something new every time for you to qualify. Improvements to products, processes, etc., can also qualify. And what we see in practice is that the R&D credit is relevant across a variety of industries because many businesses are already doing qualifying work without realizing it. So for a lot of clients, we often say that the R&D credit is really just rewarding the work that you're already doing. So the next slide, we'll talk about why we should do an R&D tax credit study at all. So an R&D study is how you translate day-to-day innovation into a credit that's maximized and defensible. The value we bring comes from four main outcomes. First, we identify the activities and expenses that qualify. We work with the taxpayer to maximize the credits while staying compliant with IRS guidance and updates. We create audit-ready technical and financial documentation so the claim is well supported if in case an audit were ever to come. And then finally, the credit can reduce tax liability either at the federal income tax level or in certain cases at the payroll tax level. Now, before we get into qualification details, I want to go through a quick timeline of the R&D tax credit and how it's progressed over the past few decades. So as you see here, the R&D credit has been around forever. It started in 1981, established under the Economic Recovery Tax Act to encourage U.S. innovation. From 1986 through 2015, it was extended repeatedly, and the rules evolved to allow more companies to be eligible. In 2006, the Alternative Simplified Credit, or the ASC method, was introduced to simplify calculation options. And then a major milestone for the credit was in 2015 with the PACT Act, which made the R&D credit permanent and expanded eligibility for small and mid-sized businesses. In 2018, the TCJA, or the Tax Cuts and Jobs Act, made the credit more valuable by lowering tax rates, especially for pass-through businesses and S corps. And then most recently, as we all may have heard, 22 through 24, the IRS put out new requirements under Section 174, which required domestic R&D expenses to be capitalized and amortized across a 5-year period, which ultimately created cash flow constraints and challenges for a lot of our taxpayers and clients. And then thankfully, in 2025, the One Big Beautiful Bill Act restored immediate expensing that ended Section 174 amortization for domestic R&D costs.
You know,
So
Adil, I'm gonna comment on that. First off, I'm gonna run one more poll question, just a super simple question. If you've ever claimed R&D credits yourself, or if you have a client who has claimed an R&D credit, would love to kind of see familiarity with it. But your comments, you know, Adil, on the history of R&D is so interesting because, you know, I remember years ago, there was a time when R&D would come and then expire and then come back and then expire. And there was a point it was expired for 2 years. So a lot of businesses, like, they never really knew, they couldn't rely on the fact that they had this support for US-based activity, that they could actually capture this benefit. I ask a lot of times in some of my in-person presentations, I'll say, raise of hands who here views the IRS as your partner in your business's success. Yeah, nobody ever raises a hand. But what's interesting is that is exactly how I view the R&D credit, is that the IRS is saying, if you are willing to take risk, we are willing to actually offset or carry some of that risk, and we'll actually help fund it, because we want, it's like the race to the moon, right? We want the United States to be on the leading edge. And so this credit is a really, really great way for companies to take advantage of that and capture some of those benefits. So, you know, as this has progressed, we've had some what I would call downsides, but where we're at now with the One Big Beautiful Bill has been so fantastic in helping support US-based innovation, thankfully, with permanent expensing being back. So that's wonderful.
Heidi, the other thing that I always remind folks, you know, I call it the One Big Beautiful Bonus Depreciation and Immediate Expensing Tax Bill. It's a little bit longer than others refer to it, but not only did we get the immediate expensing back for research and development tax credits on those expenses, which was awesome, in addition to still getting the credit, you know, we get the bonus depreciation back at the same time. And I believe, you know, the bonus depreciation, I mean, it was made permanent in the tax code. You know, a lot of folks don't realize, like you were talking about, things come and go and come and go. That's the beautiful thing that Trump did in that tax provision, was make it permanent. So, I mean, everything's permanent until it's not, but, you know, I think we have a pretty long runway there to operate under the current guidance.
Yep, totally agree.
All right. So as we just spoke about, Section 174 is the change that caused many businesses to feel like their tax bill jumped overnight, especially between 22 and 24. And during those years, like we mentioned, the companies were required to capitalize and amortize domestic R&D cost over 5 years and foreign R&D cost over 15 years. Thankfully, OBBBA, the Big Beautiful Bill, permanently restored full expensing of domestic R&D costs starting in tax years beginning after December 31st, 2024. So now for taxpayers that did previously capitalize domestic 174 costs, there's a couple of options on what they can do with any unamortized amounts that are still pending. Number one is they can continue to amortize based on the original 5-year amortization schedule from 174. Number two is they can deduct the full unamortized amount on their 2025 return. And number three is they can deduct the unamortized amounts evenly between their 2025 and 2026 returns. And one key item that I want to point out here is the special opportunity for small businesses, which impacts a lot of our clients specifically, is if you're a business with less than $31 million in gross receipts, you're able to go back and amend 22 through 24 returns to retroactively expense domestic 174 cost instead of deducting them on the 25 return. Now, if you do decide to do that, the deadline to amend those returns is July 6, 2026, or the appropriate statute of limitations, whichever comes first. So if there are any taxpayers that meet the small business threshold and capitalize 174 costs between those years, then going back and amending those returns may be the best move. We just want to make sure that we're not missing any SOLs or that July 6th deadline.
Yeah, amazing. This one big beautiful bill change or shift was tremendous. I mean, we actually saw a lot of clients just stop claiming R&D since 2022 because of the implications. Right, wrong, or indifferent. That wasn't really our decision, but there was a decision by some taxpayers that felt that they would just rather just ignore it than make a decision or continue to claim R&D credits. So the change is pretty significant. One thing I don't recall if we have a slide, so I'm gonna pop this up really quick, Adil, as it relates to one change, and that is with amortization. It's foreign R&D amortized over 15 years, and then domestic R&D was amortized or depreciated over 5 years. This new One Big Beautiful Bill allows you to expense all of that US based cost. But one thing I don't hear a lot of people talking about is that foreign R&D costs still have to be amortized over 15 years. So, have you seen any instances, or what are your thoughts on what you foresee happening? I mean, I think I know why the US government drafted it this way, in the focus of really trying to encourage US development and offset the change in costs of what it is sometimes to do development offshore versus in the US. But what are your thoughts on this shift?
Yeah, I think the shift is the same reason why the R&D tax credit ever came about, is to incentivize domestic research and technical jobs to remain in the USA rather than outsourcing to India or Philippines or wherever that may be. And we see this a lot specifically on the software development side, because a lot of that is non-manual labor like it is for manufacturing and some other industries. And the whole idea behind keeping the 15-year amortization rule with the Big Beautiful Bill and removing it on the domestic side is exactly the same reason why the R&D tax credit came into place in the first place.
Absolutely. Well, and for business owners and tax planners or CPAs on this meeting specifically, I want to kind of reiterate that as a point of consultation or guidance for clients or as business owners, I'm not hearing a lot of conversation about the fact that if you are using offshore talent for some of your product development or manufacturing or prototyping or software development, because it's a lower cost, those still have to be amortized. All of those expenses have to be amortized over 15 years. So knowing that and understanding the tax benefits or implications of that versus full expensing in the US plus an R&D credit, I think in many cases kind of flips the table in terms of making it make more sense to reconsider where you're having that work done and really bringing activity back into the US, which then also brings back to, this is actually called the increasing research credit. So as companies then begin to increase their US-based research activities, then the percentage that they're able to claim or eligible for R&D credits is likely increasing because now their activity or their QRAs and E's are then increasing to get a higher benefit. So I think strategically there's a lot of opportunity there. All right, Adil, I'll pass it back to you.
All right. So as you see here, R&D credits aren't limited to labs or tech companies, and there's a bunch of other industries that do qualify for the credit. And the real rule when it comes to qualification is less about the industry and more about the activity. So rather than thinking, are we the right kind of company, or is my client the right type of client or in the right industry, the better question that we want to ask is, are we solving technical challenges, and are we undertaking a systematic process of experimentation or testing to overcome those challenges? And the way we determine whether the work a taxpayer is doing is qualified for the R&D credit is through the IRS 4-part test. So in order for a project or the activities within a project to be considered qualified, they must meet this 4-part test. And I'll walk through each part of this test, this 4-part test real quickly. First, the taxpayer must be developing a new or improved business component for a permitted purpose. Now, like I mentioned earlier, this can be a product, process, formula, invention, software, or technique intended to improve or enhance performance, functionality, quality, or reliability of that business component. Next, we have the technological in nature test. Here, the IRS just wants to see that the activities undertaken within the project rely on principles of hard sciences. So principles of engineering, physics, biology, computer science, chemistry, or any other hard science must be used within the project activities. Next, we have the elimination of uncertainty test. Here, the IRS is saying that at the start of a project or business component, there must be some sort of unknown or uncertainty or technical challenge surrounding the capability, methodology, or appropriate design of the product or process that you're developing. So in other words, you can't already have the answers to how you're going to arrive at the final product or process, and there must be some sort of uncertainty that you're trying to resolve. And then lastly, there's the process of experimentation test. This is usually the bones and meat of the credit. Here, the IRS wants to see exactly what steps you're taking to overcome the uncertainty that you face. So to satisfy this test, you must be undertaking a systematic process of evaluating alternative solutions to your challenges through activities like modeling, simulation, design iteration, and systematic trial and error. So once again, you can't face a challenge and already know how to solve that challenge or that problem, but you must undergo a true process of experimentation for the project to qualify.
Adil, I got a question on the very first one on the last slide that always comes up from clients about what does new or improved mean? I know from way back in the day in R&D, it used to be right new to the world. You know, is this new intellectual property? Is this a patented thing? Is this, you know, is this a new scientific breakthrough? I believe, and correct me if I'm wrong, it just has to be new or improved to that company. You know, another company across the street or down the road or in their same industry could be working on the same or very similar things, right?
That's correct. Yeah, it does not have to be new to the world. It just has to be new to the company. As long as you are facing the uncertainty and going through that process of testing and experimentation, then that is what matters for purposes of the four-part test. It does not have to be new to the world. It does not have to be a patent. Now, if it is a patent, that automatically satisfies 3 of the 4 parts of the four-part test, but it's definitely not a requirement.
Thanks.
You know, I have another question on that line too, because that, again, that first part on that slide, one thing that gets a little tricky, and I see with some of our CPA partners as well, is navigating the processes part. What about if we're developing a new process? I always feel like that's a very fine line between what is technological in nature and then you're dealing with trial and error when it's process related, because a lot of times that's more you're building a system with human capital and kind of figuring out how to deliver on a particular service or something. So can you address that a little bit of how we really focus the process piece of this as opposed to like a physical component?
Yeah, so when it comes to process, we're really looking at performance and quality or reliability of that process. So in the manufacturing world, we see a lot of process improvements to improve, processing speeds for a product that's being manufactured, or overall, speed of software processes to make sure the client-facing interface is working collaboratively with the back end. So when it comes to processes, anything that is technical in nature, as long as it requires that engineering or computer science type of hard science, then process-related improvements can qualify. It doesn't have to be a physical product. If you're improving the speed at which that product is being manufactured or developed, or the way in which it is kind of processed through different lines of the manufacturing industry, then that can qualify as well.
And Adil, just to expand on that a little bit more, because this is where I see so much opportunity for so many different companies, improving their internal processes. It doesn't just have to be for external sale, use, or license of the product or the process. Just like our company internally, we're every day improving our, how clients come into the system, how our billing, with medical companies, how they're doing their billing interaction, for payments, how they're doing their CRM integration, their ERP, their, all those technology related new things and the AI buzzwords where they're improving their internal processes. I mean, almost every company is doing a version of that or they're getting left behind.
Yeah, and just to add to that, I mean, as long as you're not just buying something off the shelf and implementing it within your company and not, once again, facing those technical challenges through that process improvement or process innovation, that is still qualified time. Even if you're buying off the shelf and still, customizing a software, customizing a piece of equipment to fit within your existing processes, that is all time that could be qualified towards the credit. All right, so here are a few common examples of activities that often qualify when they align with that 4-part test. Activities like designing and testing new products or systems, iterating to improve performance or functionality, developing and refining prototypes, and evaluating alternative materials or methods are all qualified activities as long as they are intended to solve a technical challenge or uncertainty faced on the project. Now, on the flip side, there are also some very clear categories of work that are typically excluded. So this slide gives you some examples of some of those common exclusions under Section 41. Now, the big thing to point out here is even if a project feels innovative, we still want to make sure that we're separating qualified technical work on the project from these excluded activities that are listed here. And once we've identified qualified activities, the next step is understanding which costs can be included towards the credit.
Yeah, these are huge ones. Sometimes when we're looking at a company that may or may not qualify, one of the things that we like to have the discussion about is, are there right off the bat any excluded activities? Because, one of them as well is looking at, let's see, funded research. So if there's a funded research component where they're receiving grants, we've had a few companies that have federal grant funding that essentially would eliminate that portion of that amount for the R&D credit. And then who retains the rights for that as well. I think those are really important key points. So if you're ever having a conversation, if you are a business owner or a tax consultant working with a client, those are some key questions. Is the activity based in the United States? Do they retain the rights to what it is that they have developed? And just make sure that they are actually building that and owning that moving forward.
Rights and risks. Those are the two words that I always think about when I'm talking about with clients. Rights. Do you have the rights, to the knowledge, the know-how, the information that you're gaining from this? And risks. Is there a risk that what you're doing isn't going to be successful, or you're not going to get paid for it, or it's money down the drain? Or, like you said, is it funded, meaning, hey, we're going to work on this project, and even if it doesn't work, we're going to get paid for it anyways?
All right, so to calculate the credit, there are 4 main buckets of costs that we look at: wages, supplies, contractors, and cloud computing costs. So wages are almost always the driver of the credit. This is going to be any employee that's directly involved in qualified R&D work or directly supporting or supervising the R&D work. So what we do is we identify what percentage of each individual employee's time in a given year was spent on qualified research activities versus non-qualified activities. Then we take that qualified percentage and apply it against that employee's W-2 wage to get the qualified wage expense, which is ultimately plugged into the credit calculation. Similarly, for contractors involved in qualified R&D, we do the same thing. Now, with contractors, like Mike had mentioned, we do need to look into payment terms and rights ownership to ensure that the taxpayer maintains economic risk and rights to the work being performed. So that's an additional step when determining contractor costs. And then one other item as it relates to contractor costs is we can't capture 100% of any contractor wage or contractor payment. We have to take a 35% haircut to whatever the ultimate qualified contractor expense is and only capture 65% towards the credit calculation. Next.
One question I have for you before we move to this next slide is, sometimes it's nice to just really simplify. Like, when does it make sense and when does it not make sense? And when we look at what is the total cost, like we end up having a lot of conversations with people that have qualified R&D expenses. They have activity, it's there, but maybe it's a startup and it's a founder who's not taking a salary, and so they're not paying themselves anything yet as they sort of build this business. Or maybe it's someone who's offshoring everything, or their costs are very low. They're building something and the prototype was $20,000. It's not that those don't qualify, but when we look at doing a complex analysis to calculate the credits, where is that threshold? It's difficult because it's not a black and white, and we don't want to set that that parameter either for our audience here. But I think it's helpful to know is like, where is that range where once we see that there's a certain annual expenditure, when does it make sense to begin to explore an R&D study?
Yeah, so I guess I'll start by saying an R&D study, if we were to do a very, very high level estimate, it's anywhere between 5 to 10% of total R&D qualified expenditures in any year. That's what the credit amount ultimately ends up being, is within that range. Now, when does it make sense? Personally, for companies that we deal with on the ETS side, anywhere between $300,000 to $500,000 in qualified research expenses is when it makes the most sense in terms of value, after accounting for tax return amendment fees and ETS fees and things of that nature. But we have seen situations where clients expect immense growth in the coming years, and what we do in those situations is we'll tell you to hold off on maybe doing a 25 study, and then we can loop it in with 26, because we do have that 3-year SOL turnaround that we can go back and amend and take the R&D credit for. So if you don't have that $200,000-$300,000 qualified research expense range currently, but you're expecting that in the coming years, then once that year comes, we can always go back and bundle everything up into one analysis or one study, so it makes the most sense for you financially.
And Adil, that $200,000 or $300,000 of expenses, I mean, I've seen with clients that can add up pretty quickly, once they realize what goes into that calculation, especially in the wages, because, if you have 2 or 3 people, on the low end that are working on a project, and they're making $75,000 or $100,000 a year in wages, plus, they forget, or sometimes that one level of supervision and support is also added into that calculation. You can get to that number pretty quickly with a lot of clients.
And just to add to that, I mean, like I mentioned, we figure out a percentage of your employee's total time spent on qualified research activities. If that percentage is anywhere over 80%, then we're able to take automatically 100% of that employee's wage. So that's usually a good way to boost the qualified research expenses for that employee as well.
Absolutely, love it. I do have another poll question up, just in case you do want a CPE certificate. Please make sure and check this, because we will be issuing those, but probably only to people who are asking for them. So please make sure and complete the poll. Okay, Adil, back to you.
Adil, there is a question from Toby Wright on the question. I don't know if you want to address that now.
Sure, let me pull it up.
I can read it to you. The question is does taking a training course to develop a skill that will then be implemented during an R&D study process, does that count towards R&D? And I love this because we get this where we say, well, yeah, one of our employees went and did this training to learn this skill because we want to add this service to our business or something along those lines. So yeah, love to hear the answer to that.
Yeah, so training would fall under the exclusions that cannot be captured towards the R&D credit. So training, marketing, anything that's non-technical is not capturable in terms of qualified activities. Now, once you use the knowledge that you learned from the training in the R&D project itself or in the process improvement itself, then we can start to capture that time towards the credit. We just want to make sure the training doesn't necessarily tie into the technical uncertainty aspect of it, or it doesn't tie into any performance, functionality, or quality or reliability of an individual business component, but it's preparing you to get into that stage.
It's such a great question because, like Heidi said, it comes up all the time, and there's a lot of training that goes on, and I guess that's why the R&D study in our team, it's a blend of an art and the science. The science part is easy, like we collect the numbers. It's the art of figuring out what are they actually doing, where are they doing it? Are you attending a training session off-site, or are you training on a machine in your facility and you're working out the details? I guess that would where it would translate more to a technical, hands-on type of in-house training, testing, whatever you want to call it, as opposed to outsource training or marketing.
Yeah, perfect. Thanks for the question, Toby. That was a good one. So back to how the R&D credit now is actually used. So this, this is a little bit of the process we go through when we're having a conversation with a particular client or business owner that may be able to claim a credit, is we're really looking at the 4-part test. Is the activity falling within the outline of what the IRS defines? Number 2, is there anything that would exclude that business from claiming the credit? Is it foreign expenses? Is it funded? Any of those things. And then 3rd, what is your ability to use the credits? So this is really big. So you may be eligible for a tax credit, but now who has the ability to actually use that based on how these credits apply? So let's dive into that a little bit.
Yeah, so I'll start from the right side of this slide. So from a practical standpoint, there's 2 common calculation approaches. There's the regular credit method and the alternative simplified credit method, the ASC. And the very high level ballpark of where the credit amount falls is, like I mentioned, between that 5 to 10% range of total qualified expenses in the year. So just to keep things quick, the regular credit is more aggressive and it's more sensitive to past performance, while the ASC method is more conservative and more straightforward, only looking at the prior 3 years of R&D as opposed to going back to inception. Our role is to analyze both and help determine which method makes the most sense based on the taxpayer specific facts and how far back the taxpayer can go to gather documentation and data to support the credit calculation. Now, in terms of how it's used, the credit can be offset or can offset federal income tax liability. And if a business can't use it all in the current year, unused credits can generally be carried forward up to 20 years. For qualifying startups, there can be a payroll tax offset option as well, if no income tax being generated. Now, in order for it to be beneficial to utilize the credit towards payroll tax offset, the client must have less than $5 million in gross receipts and less than 5 years of having gross receipts as well. With payroll offset type R&D studies, they can only be filed on an original return, whether that's timely or extended, does not matter. It just cannot be amended.
Perfect. The ASC method, Adil just hit on this very briefly, but prior to this change, which we showed in the timeline, I don't know if any of you guys remember a time when the R&D credit calculation required, he alluded to this briefly, going back to the inception of the company. So what that meant was, like, we had an actual example, and we're going to get to case studies next, so Mike can share some of his real world experience, but we actually had a client where it was a 2nd generation company and they had been in business for 47 years. And we had to get data about what they did in terms of research or projects from 47 years ago. So we're like, is anybody around that remembers what you did the year it was founded and what kind of projects you worked on? But as you can imagine, that is oftentimes not an option. And it's not available information or data to rely on. And so it actually did create a situation where some older, long existing companies really couldn't claim the credit, or it just didn't make sense because it was just the effort was very, very difficult. So the expansion of allowing the ASC method really was fantastic, because then we really only have to look at that prior 3-year period, and opened that up for a lot of older businesses that just said, it's not worth the exercise of trying to get the older founding year data. So really good things happening there. So Mike, we're gonna push it over to Mike for some case studies. Mike has personally facilitated millions and millions of R&D credits claims for probably every industry, right, Mike? All over the country. So why don't you talk us through, we have a number of 4 or 5, I think, case studies where we can talk about some different industries, the types of qualified expenses that they had, what those totaled, and then how the credit really applied to them, and maybe some kind of background on the types of projects they were doing.
Yeah, absolutely. And I'm going to try to be as transparent as possible, but also conscientious of confidentiality, because I know all these clients, really well, and that's the other thing we pride ourselves with is being very respectful for confidentiality, especially when we're dealing with research and development and what companies are doing internally. So we're very sensitive to that, and we're dealing with people's wages and who their contractors are and all of that kind of stuff. But I'm going to give you some great information of what I can share, and these are absolutely real, very recent studies that we just completed this year, all within the last couple of months. This is a manufacturing firm that's in the New York City area. Came to me from a CPA firm that I work with and have worked with for years. The CPA firm is pretty good at identifying opportunities and potentials. So they get me on the phone with the clients right away. Even with ones that may or may not, be a good candidate, we quickly get down to the details. And last fall we started working with this client. It's a manufacturer. What I can tell you is they do innovative digital signage type boards, that you'll see in subways, on buildings, on other things. And it's not those things that qualify for the research and development, but it is how they manufacture some of these things, what the processes are for the racking of these different signage boards, how they go on safely on different buildings, how they manufacture, like Adil was talking about, the process improvements, the testing that they do, the efficiency in their process. Really cool client. They're expanding. They do have a fairly large team, that is both manufacturing and doing, R&D with some of the new technologies that go onto these digital boards in different formats, and the security that goes into the boards themselves, so someone doesn't just come in and pop up something else on their sign that they're not aware of. So there's a lot of things that we found out. Of course, the wages, was a $2.4 million number. The supplies, that they get for making the racking, the contract, research, third-party companies that they work with to help make it all happen. And look at that. In one year, we got them a $703,000 R&D tax credit.
Amazing.
Pretty cool. Pretty cool.
Yeah. Well, it's interesting too, because, you look at their wage and supply costs, but really the majority of their cost was with contract research. So it was outside contractors or consultants that they hire to do a lot of the technical work for their projects. So I think that's a really interesting case study for this particular client. The next one looks at architecture. And I always love this conversation because I think Adil hit it on the head earlier, is a lot of people say, well, this is what I do every day. How is that R&D? Like, that's all I do. And you're like, exactly. And so a lot of times, particularly in this space, a lot of our clients, they never think of it being that innovative until they really dig in and understand. So this is kind of a fun one.
So this one, actually, I wouldn't classify them as pure architecture, although we work with a ton of architectural firms and engineering firms and design build and specialty contractors. I would actually call them more of a specialty type contractor. This firm, what I can tell you about them is they do elevator modernization. So imagine all the elevators across the country, and there's other companies that do this kind of stuff that I need to reach out to and tell them, hey, there's some opportunity here. So imagine every elevator in every old building in New York, New Jersey, Cleveland, Boston, whatever. Someone needs to go in there and figure out how to re-engineer an elevator in an old shaft with new equipment, and the safety, the security, the testing of figuring out how to re-engineer a new elevator. I mean, it's an old school thing, but there's a lot of new processes, procedures, testing that they do to figure out how to keep that building structurally sound and safe, and those elevators working, and implementing all the new technology, with safety, with monitoring, with communications. So that's what this firm does. They had a lot of qualified research expenses. We've been working with them for years. Again, I was introduced to them through their CPA firm, who thought there might be an opportunity, and man, there was. Look at that. We got them another almost $1 million of R&D credit.
Absolutely.
construction and engineering in California. This is another similar type company that's doing, specialty contracting. They're based in California. They have other regional offices. It's figuring out how to, safely, look at situations in buildings, figuring out the unique building orientation, different requirements for earthquake, for fire, for construction methodologies that are going to be used in the building, finding the new techniques, finding the new products, that go into that. They have a whole team that just does this. I mentioned elevator modernization. There's companies that work on building, modernization, and how does that translate into the construction and engineering processes, of building orientation, how to deal with wastewater, how to deal with natural disasters. There's a lot of that goes on. Is another great client that we've been working with for years.
Yeah, and a comment on this one, I think it's important to note that we've been talking about the R&D credit in general, but we haven't really honed in the fact that there is both a federal credit as well as a state credit in many areas. So in this scenario, you can see that the gross credit is right there about 10%. So that's pretty significant. But when we're looking at the federal and the state credit, California happens to follow feds mostly on this R&D, which they don't necessarily do. As you may know, they don't follow bonus depreciation. They don't follow some of the other rules, but they do follow the R&D. So in California and New York, some of these high tax states, it is very compelling because essentially they're almost getting double the tax credit amount because they're getting both the federal credit and the state credit. So then when you compare that to this one, you'll see that from a percentage standpoint, the percentage of the tax credit is not near the 10%. And so there can be multiple factors around the increasing research amounts year over year. But Mike, I'll let you share a little bit about this one.
Yeah, this is a client based outside of Cleveland, Ohio. Coincidentally, that's where I'm originally from, grade school, high school, college in Cleveland. So, go Browns and Cavs and Guardians and all that fun Cleveland stuff. That's how I met the client, through a regional CPA firm in Ohio. This is actually a private equity owned manufacturing firm. So there's actually 3 or 4 different subsets of companies, but this is just one of their companies that manufactures precision parts, that go into engines, that go into, all kinds of things. just like you see in that picture, someone's making a piece of a part that goes in there. It's their testing, it's their manufacturing process, it's the materials and supplies, which actually weren't even calculated into this. I mean, we just focused on the wages because it was a slam dunk for them. But again, this is an old school manufacturer example. Agriculture in California. I mean, here's one. I mean, there's a tip off to what it is. Wineries, breweries, things like that. We work with those types of folks too. It's how are they cultivating that land? What are the innovative new things that they're doing for soil testing, for remediation, for things with air purification and other things that go into their systems. So whether it was wine in this situation, or brewing beer or whiskey and distillation, processes, there's a lot of wages that went into that for their whole crew, that's focused on it, and other requirements that they had for the state of California for water and other things. Materials and supplies was a little bit higher in this one, as you can imagine. They have a lot of, manufacturing and distillation and refining equipment that goes into it, but also contract research, other companies that they have to work with for soil, for air, for water, for, process flow of their thing.
Yeah. I mean, on this one too, one thing that some things have come up a few times is like wineries that are making new labels. So they're creating a new label, a new taste, a new name. There's a lot of graphic design, there's a lot of marketing, there's a lot of branding that goes into that. That typically does not qualify. That's something I've been asked many, many times. So I like to kind of explain that although they're developing that the marketing component of that is not something that would roll into the credit. Supply costs, when we look at equipment, doesn't qualify. But what does is typically, you think about what's happening in the world around us. Like, have y'all seen like the sugar-free wines, and now they've got the additive-free wines, and now we've got the organics, and now we got the, paraben-free or whatever, all of these new things that they're coming up with, or fully organics, things like that. Those all require a lot of food science to really figure out, well, okay, how do we make this then so it doesn't spoil, but it doesn't have the additives people want? And that scientific experience that they have to go through to continually refine those products. So yeah, we see that in food science along with many of these different industries.
And packaging, like you said, a lot of the marketing type of activities are excluded when it comes to labels and other things. But the thing I think about with that client and many other foodish type companies, how are they packaging in that? How are they packaging it safely? What kind of bottles and materials and boxes are they using so they can actually ship it without it breaking? So there's a lot of other things that we look at that applies to a lot of other companies that are doing similar things.
Yeah, absolutely. So we do have pre-qualification questionnaires on our website. So this link, we do have a PDF of the slide decks in this portal as well. You should be able to download them in the view somewhere. We will send a link out via email with the recorded webinar as well as a slide deck. But there is a link you can go to the website. If there's a client, they can click through here and answer some pre-qualification questions to determine if they are a good candidate for R&D, and then essentially put in some generalized annual expenses so we can get a gauge of what the potential qualified amount could be. I know a lot of people are like, well, how much may I qualify for? So that's always really the first step in identifying that. Other things that we want to touch on, the Mike's going to cover a little bit about, really the other things that we then pad into our service offering as we're going through and working with some of our clients in the R&D space, a number of other things that we can help supplement in terms of bringing value. So Mike, let's cover this real quick.
Sure. So again, as Heidi mentioned, we try to be as comprehensive as possible and identify what are the other pain points that our clients have. I mean, we know they're tax and accounting, where we can help them and pick up any credits, incentives, whatever. But, usually there's always an insurance need, either for the company or for their buildings or for their people or their, vehicles and machinery and equipment. So a couple of years ago now, we developed our own internal company to do, commercial insurance so that we have all the same information when we're doing those cost seg studies or we're doing the research and development tax credit study. We know we have the right contacts. We have typically the information on the buildings, the location, the high level things of revenue and operational factors. So we can be very comprehensive, very entrepreneurial and proactive with not only going to market to make sure we're getting any of your tax credits, but from an insurance standpoint, where can we integrate it? We have the great relationships with carriers nationwide, for all different business lines, whether you're in manufacturing or you're in hospitality or you're in real estate, blend it all together, be proactive, go into market. The good news is we have seen some rate decreases, in just the last few months in California, in Florida, in Texas, in the Carolinas where I live, where we've all been hit with some natural disasters and some other things. Now's the time to be going to market for that. And our team is excellent. They're very tech forward. We'll make it super efficient for you and get the tax credits and some insurance savings and risk mitigation wherever possible. Yeah. One of the other ways that we do this, you want to give the overview on this, Heidi? Or do you want me to do it?
Sure. I'll jump into like incentive reports. This is one of the ones I think I'm the most excited about as we look at added services that we have brought to the table over the last 3-4 years. This was actually an acquisition we did of a really, really cool technology platform that ultimately is able to analyze over 2,000 local, state, and federal incentives. And what we do is we go through the R&D credit analysis, but the data that we have about the company gives us the data needed to plug it into this software that then actually goes through and identifies any and everything that can apply to that particular business. One of the cases is that we have this phenomenal client who's actually in the semiconductor space. We were actually able to help him on the insurance side because he's doing semiconductors for the Department of Defense. And he could not get insured for a certain percentage of his business because of risk as it relates to doing federal projects. So we were actually able to analyze that and find a package that worked for him and did cover his liability. And then with the incentive report, he's a California manufacturer. He had no idea there was a California competes credit. He did not know there were California training credits for training his staff and improving their manufacturing abilities and engineering, and about 5 other things that he had no idea he was eligible for that generated some absolutely dramatic incentives for his business. This is not, I want to drive this home. Our incentive reports are to drive added value for you and your clients. That many of these things, they're not even things that we are delivering on. They're not things we're selling. They are resources and tools where we say, here is a link to this application that based on what we've seen, you qualify for this, you should fill it out and get it because this is just sitting there at the table for you. So it's this type of stuff that just really expounds on our value, or I should say our desire to want to be an added partner, to bring value to you, to your clients, and make sure that we're leaving no stone unturned when we're looking at what incentives apply to our partners, to the businesses that we work with, and that we're not just, out here to close a deal. That really we want to work moving forward and bring value across the table. So incentive reports can be tremendous.
And Heidi, the information we need is simple, for this. Same with R&D, same with cost segregation and bonus depreciation. Just get us the basics. Where is the company located? What's the physical address? What do you do? Are you a manufacturer? Are you a tech company? Are you whatever? Just give us an overview. Where are you located? What do you do? How many people do you have? Do you have separate locations in different states? For example, this morning I just talked with a company together with one of our partners and our CEO. It's an aviation company, actually a helicopter company with a couple different locations. Once we found out where they're located, we quickly developed an incentive report for them, and we quickly found some things that they weren't aware of. Not only some grants that they weren't aware of, but also some job training credits, some of their locations. So we look industry based, we look geographically based. Industry based, there was some job and industry incentives available. Geographically based, we highlighted that some of their locations are in opportunity zone locations. So there's some things that just based on geography, like, hey, are you taking advantage of the opportunity zone program if you're going to be setting up some new companies or some new things? So they were very appreciative of that. And so take advantage of our incentive reports. Just need to know where is it, what is it, and then we can, put together the roster of all the things that we can do to help and be strategic.
Yeah, I mean, I couldn't agree more. To Mike's point, the semiconductor scenario that I was sharing a second ago, he actually is looking to relocate, as we unfortunately see a lot of business owners looking to move outside of California into an environment that's a little less cost intensive. And so the incentive report did actually help evaluate 3 different states and locations that he was exploring, and helped him see what some of those local incentives would be for him to open up a manufacturing facility. In addition to the One Big Beautiful Bill, there are other benefits to opening manufacturing facilities specifically that relate to depreciation, coupled with opportunity zones, coupled with local incentives. It is unbelievable the opportunities that exist if you know where to look. And that really is what we're aiming to do, is provide value in that space. With that, we're at an hour already. We were going to have some Q&A, but I think we hit that kind of as we progress through the meeting. We will be sending out a link to the recording as well as a link to the PDF slides if you did not download them here. Make sure you have those. But please give us a shout if we can help in any way. We will send the email with contact information, but would love to hear from you, answer your questions, and share any feedback that you have. So thank you so much all for joining us today. Mike and Adil, thank you so much for sharing your insights and expertise.
Thanks, everyone.
Thank you, everyone.